So if you're a founder and you are not building an AI native company, that's fine. You just need to have a story as to why you're not using it. I think next year is going to be a better year for founders, a better year for investors. If you were to raise about $1 million of pre-seed capital, you're selling about 10% of the business on median these days.
Hey everyone, this is Taissa Maleh, venture partner at Pegasus. In this special episode of VC Unfiltered, we're bringing you a previously recorded webinar with Peter Walker, head of insights at Carta. Peter shared some invaluable data and trends with our LPs, venture fellows, and emerging angels, highlighting what's shaping the startup landscape as we head into 2025. So if you're serious about staying ahead in the ever-evolving venture ecosystem, this one is for you. Let's dive in.
Hi, everyone. My name is Peter. I run the insights team at Carta. I won't bore you with too much about Carta and what we do, but just to give you a little bit of context on the data itself that we're going to run through today, Carta serves about 45,000 startups here in the US and over 55,000 across the globe. We are the leading cap table management software for private companies. We also have a growing, burgeoning business in fund administration, where we actually serve as the back office for about 3,000 venture funds here in the States. So you've got company data on one side, aggregated and anonymized, and fund data on the other side, aggregated and anonymized. And we can put those two aggregated pools of information together and kind of produce insights around what's happening for venture-backed startups in a way that we think is pretty unique. I don't know of another data set that's this robust around private companies and how they're being built. So as mentioned, just going to run through what the heck happened in 2024. We can talk a little bit about 2025, what's going to happen then. But if you have questions, throw them in the chat, throw them in the Q&A. Would love for this to be a back and forth as well. This is a little bit of wonderful text from our lawyers. I'm required to show you that. So exciting kickoff. As mentioned, data comes from 45,000 companies. It includes priced equity information as well as rounds done on safes or convertible notes, which is a big deal because safes and convertible notes have become much, much more common lately. In a couple graphs, maybe not, but most of the time, this data is just talking about US companies. This was the exciting run-up period that we all felt from 2018 to 2021. At least on Carta, nearly $70 billion was invested into Carta companies in a single quarter, Q4 of 2021. And now this is where we are today. So we had that giant run-up and this denouement, fall back down to grace. Now, if you look at the actual values, though, it's about $20 to $24 billion a quarter being invested into Carta companies today. That's effectively where it was in the beginning of 2020, maybe a little bit lower than where we would have expected it to be if you had some natural growth. So it feels like venture is in this slowdown period because we're comparing it to the peak in 2021. But realistically, that peak was never going to last. That was the sugar rush. Now is actually a much more normal time for venture. I know for founders maybe listening in that it doesn't feel that way, but this is much more normal than 2021 happened to be. So if you look at this same data for fundraising over time by stage, you can see that the closer that you were to IPO, the harder this downturn has hit your peers and your venture community. Series D down about 65%, seed down around 45%, but no part of the venture ecosystem was able to escape the downturn that's happened over the last couple of years. And so what are the impacts of that fundraising decline? The first thing that founders on the call should know is that the old venture advice of fundraising every 18 to 24 months, that is out of date. So that would be the blue zone on this chart. And you can see for a while that blue zone was totally true. This is one of the pearls of wisdom that you hear from VCs that's actually proven out by data. It used to be that, yes, you would fundraise every 18 to 24 months. But a lot of companies are having to wait 2 years, 2.5 years, 3 years even for their next funding round. So if you're planning on fundraising every 18 months, you are giving yourself very little margin of error. So give yourself a little bit more room to maneuver and probably try to make that cash last at least 2 years, if not a little longer. Which begs the question, what the heck are these VCs doing if they're not funding new companies? Well, they're doing quite a lot, But one of the things that they've done much more often lately is bridge or extend the companies that they're already involved with. So you can see that bridge rounds are taking up very large shares of each of these segments. 40% of all Series A rounds last quarter were actually bridge rounds. So a lot of these companies are coming back to their current investors and saying, hey, we need more cash. Are you able to help us through this down period? And then investors are having to choose amongst the portfolio companies they've already invested in.
Peter, we have a question on the chat. How does this decline compare to the past declines?
Yeah, so Carta was founded in 2013. So I don't have great data on what happened in the great financial crisis, for instance, or the dot-com boom. I will say that venture as an asset class is much, much, much larger than it was in either the dot-com or the great financial crisis. Many multitudes larger. So private markets are just taking in more and more capital. So the declines may feel the same, but the numbers, if you look at the absolute value of these things, would be much larger today than they would be in the past. So we've got bridge rounds happening. If you can't raise a bridge round, what's the next thing you might do as a founder? You might end up having to raise a down round. So a down round, any round where the valuation falls from the prior valuation. About 20% of all rounds on Carta these days are down rounds. That's about 2 times higher than the usual 10% or so. So it's happening far more often. There's a little bit less of a stigma attached to it, which I think is a good thing. And hopefully that these companies that are taking down rounds are making changes to the underlying cap table and valuation of the company that make it easier to move forward. It's not an easy thing to do, but sometimes it is the right choice for the business. And if you can't raise a down round and you can't raise a bridge round and funding is drying up, unfortunately, that does mean that some companies are having to shut down. Now, we had a boom in startup funding in 21, obviously. So you would expect that many of those companies will not end up making it and have to shut down 2 to 3 years later. Well, that's the period we're in right now. So this will be the highest year of our lifetime on Carta for startup shutdowns. We think 2025 is going to be a little bit better, but it's not easy, and a lot of founders are having to make some really difficult choices. Okay, so that's what's going on, general context. I want to jump into pre-seed, which is one of the most exciting parts of the venture ecosystem right now. I'm going to skip past a couple slides here that are for founders mostly, but one of the things that's really changed is, do founders really need to fundraise? It's a question that wasn't asked very often in 2021. It's being asked a lot more often these days. Bootstrapping, revenue funding your business is becoming far more common, and people are approaching venture capital as not the conveyor belt up through the alphabet stages, but rather an a la carte menu. Perhaps they can choose one round and then get to profitability and build their business that way. A lot of different methods, a lot of different tactics being used right now around venture. When you are fundraising on pre-seed, you do it on a safe or a convertible note. And you can see from our data that safes have become much more common than they used to be. Something like 90% of all of the companies that are raising pre-seed rounds on Carta are doing so on safes as opposed to convertible notes. It's a big, big shift over the last, call it 4 or 5 years. Okay, so we've got safes dominating the landscape. 2 terms that matter on a safe, a val cap and a discount. The valuation cap sets the floor, or excuse me, sets the ceiling of the conversion. The discount sets the floor. Most safes that we see on Carta have just a valuation cap, and that's it. I don't understand why, to be honest with you. If I was an investor, I would insist on a valuation cap and a discount. I don't know why many investors don't. Part of it has to do with defaults, I think. The valuation cap only is the default on the Y Combinator website. So when people download these documents, they download the valuation cap only set of terms. But the discount protects the investor if the startup doesn't end up raising above the cap. So you can see about 30% have both of those terms applied. Discount only, it's about 9%. And then an uncapped, undiscounted safe, only 1% of safes. It's basically no one does that kind of term. I'll challenge you on this chart to take a second and see, when did Y Combinator change the defaults on their website from pre-money in the blue to post-money in the dark gray? If you were thinking right in 2020, you're right. This is just a great chart to show the power of defaults on affecting startups. When Y Combinator made that change, it moved from about 50% pre-money and 50% post-money to now nearly 90% post-money safes. Post-money safes favor the investor, not the founder, but they do give more clarity to everyone involved in the fundraise. So if I invest $1 million into a 10 million pre-money cap, I, as the investor, have no idea how much I'll end up owning. Whereas if I do that same investment on a post-money cap, I own 10% of the business, maybe a little less given some option pool dynamics, but pretty close. So that's why investors prefer the post-money cap. There's three other things that are happening, or a big thing that's changing with safes is that a lot of investors are now using side letters to get priced round rights alongside safe fund economics. So you've got these terms, most favored nation, MFN, information rights, and pro rata. All of these are rights that the investor might want in a given deal, and they typically come as a side letter to the standard Y Combinator safe. Side letters are becoming much, much more popular than they used to be. The early part of this venture market is doing pretty well in terms of investments, about $1 billion a quarter, a little less in Q3, although we expect that to pop back up with some more data. So every other part of venture had a really big downturn. Pre-seed, not so much. Still a lot of attention and excitement in pre-seed. In terms of these valuation caps for these companies, this is the first time that we've spoken about AI. We'll touch on it a couple other times, but AI companies are raising at higher valuation caps than non-AI companies, to be expected. The AI is the orange line here. The black line is everybody else. And if you look at this chart, really what this tells you, if we flip to the next one, is that if you were to raise about $1 million of pre-seed capital, you're selling about 10% of the business on median these days. The width of these distributions is very wide. So some are better deals than others, but on a median basis, it's about 10% of the company for $1 million at the pre-seed. And most founders, as I mentioned, start on safes. They seem to be sticking around on safes longer than they used to. So it used to be that this chart maybe would have flipped over to priced equity, right around $1 million or maybe $2 million. Now it's more like $3 million where you flip from safes to priced equity in terms of the round size. And then once you get to 4 or 5, big rounds, those are done on traditional priced equity, standard venture deals, as opposed to on safes or on notes. I'll pause there. Any questions on price or any questions on pre-seed or what's happening with valuation caps, anything like that?
I got a question. So, Grace, I've seen some articles saying that large VCs are exploring pre-seed more. Can you comment on?
Grace, I think that this is actually not true for a couple of reasons. One, the difference in check size at pre-seed is really, really wide. So there are some VCs who are traditional seed VCs who are starting incubators or little accelerators or like putting pre-seed checks into more businesses. But multi-stage firms or big VCs going all the way down to pre-seed, we honestly don't see that happening too much. In fact, most founders that we talk to say that there is very few institutional pre-seeds out there that really do pre-seed investing. So it's a dynamic space, but in general, I actually don't see big firms going all the way down to pre-seed. Most of them will stop at seed.
We have more questions. Carmen is asking if you can chat about the geo differences at pre-seed.
Yeah, so there are geo differences here for sure. Silicon Valley startups are going to be valued in different ways than, say, startups in the Midwest or in the South. Typically, we see about a 20 to 30% premium for companies in California, for instance, at this stage. But again, the distributions are very wide. So, you can have a company that's raising a round that looks like it's in Silicon Valley, and that company is based in Atlanta. And you can also have a Silicon Valley company that's raising a very small pre-seed round. So deals are getting done sort of all over the place.
On that note, do you see any difference in major difference in valuation caps?
Yes. So if you have a valuation cap of 10 million and you're raising about $1 million in the Valley, maybe that valuation cap would be more like 8 million if you're raising that same amount of money in Atlanta or Charlotte or Dallas or places like that. New York and California, New York, and Silicon Valley are basically equal most of the time. And then the next three markets would be Boston, LA, and Seattle or San Diego, depending on what kind of industry you're in. I think Boston is the underrated story of venture. I think Boston is going to challenge New York for second place pretty soon. They have started in biotech, but have rapidly expanded beyond biotech with really strong health and SaaS and an increasing AI ecosystem as well. So very bullish on Boston.
As a New Yorker, that hurts me.
Just telling you what the data shows. I'm sorry. It's a great example of an ecosystem that like doubled down on its strengths within biotech, and obviously the university ecosystem in Boston is second to none, and then sort of over time expanded to different areas. I think it's actually a model that I think other ecosystems could use as well. They probably won't benefit from having Harvard and MIT there, unfortunately. Okay, let's talk about price rounds. So to this overall point, has the amount raised in these rounds gone up over time? Yes. The answer to your question is definitely. If we look at valuations to begin with, though, this is seed round valuations on Carta. The black line is the seed round valuation, the median for that quarter. And the bars behind it are just the number of rounds that got done. The orange line is bridge rounds. We can ignore that for a moment. So two things stand out from this chart really clearly. The first is seed round valuations are about as high as they've ever been right now. Nearly $15 million pre-money valuation for seed stage companies. That is influenced by Silicon Valley and New York a lot, but we're also seeing this trend go up in a lot of cities across the US. So that's very expensive. The round volume, though, the bars, that's the other story. So whereas about 900 companies raised a seed round in the last quarter of 21, only about 470 raised a seed round, primary seed round in Q3 of 2024. So valuations are high, but fewer companies are getting to raise at all. And that's a dynamic that we see repeated across different sectors, which is effectively what happened when the boom went away is that there was a quartile of companies, call it 25, 30% of companies, that just no longer were able to raise anything. And the companies that did raise were having more competitive rounds. So valuations rose, but total volume declined. And you can see that same story repeated in Series A, about 50 million bucks as $45 million pre-money valuation for Series A. You raise about $10 million in a Series A. So you add that together, 45 and 10 gives you 55 million as a post-money valuation for a Series A round on Carta. Expensive, very expensive. But again, if you look at the round volume here, it's even more dramatic at Series A. So fewer companies raising, but the rounds that are getting done are very robust. You can see that these rounds, seed, Series A, they're useful names because we have to call these things something, but they also have a ton of variation within them. So not great as if you're a founder to compare yourself to all the other rounds here. There are Series A rounds where 6 million bucks are raised, and there are Series A rounds where $25 million are raised. There are same thing with seed, same thing with Series B. There's a huge variation within a single stage name. So don't focus too much on benchmarking yourself to the median and you have to raise the median. Deals are getting done all over the place.
Can I ask a question very quickly? Does this data that you're showing us now include both AI companies and every other sector?
It does, yes. That's a question I get a lot. Like, why don't you strip out AI? I mean, one, there's a hype cycle in every single period of venture. So whether it was AI or crypto or mobile or hard tech or et cetera, there's always something. There's always the hottest sector on the board, and you don't strip those out of the overall numbers. Venture is a power law ecosystem. However, if you do strip AI out here, I think it's useful to know for the non-AI companies that one, AI takes in about 30% of cash on Carta. It's a lot of cash, but it's not everything. It's not even the majority. That's up from 11%, I think, 2 years ago. So big increase, but it is not everything. You can still raise if you are not an AI company. The second thing is that non-AI valuations are also rising. So it is not the case that AI is shooting upwards and everything else is going to zero. That's not true. The interesting part is what's going to happen in 2025. From the conversations that we're having with investors, what seems to be the case is that AI is no longer, it's undergoing a transition from the reason why you invest to part of the tech stack. So if you're a founder and you are not building an AI native company, that's fine. You just need to have a story as to why you're not using it. If you haven't thought at all about why you're not using AI in your company, you should. And you should have a good story as to why you've chosen not to use it. And most of the time, we see that AI is now moving from, say, the front of the slide, the front slide, the title to the tech stack. It's kind of like for many companies, like using React or JavaScript. You wouldn't call yourself a JavaScript company, but you're going to use the latest technology to accomplish your goal. That's the dynamic outside of the foundational models, which are obviously still very, very heavily invested into.
How is LA doing compared to these other markets? And how has it done over the last 10 years, if you have any data on that as well?
LA is typically the third or fourth market in our data. So it competes with Boston for third or fourth place. So this is a chart that shows you the top 10 US startup ecosystems for seed and Series A, so early stage fundraising over the last, call it 12 months or so. So number one is the Bay, basically number one across most sectors except for fintech. New York is number two. LA came in fourth, but LA was showing real strength in hardware, fintech, and consumer. And then, on the list for health tech and SaaS as well. So LA is a great ecosystem because it's become more diversified in terms of the industries that it serves over the last 5 years, especially, we've all read the stories about Segundo and the hardware boom that's happening there. But it's a really broad-based ecosystem, and it's, I think, increasingly competitive and could get back into that top three with Boston over the next 5 years. Depends a little bit on how some of these industries grow, but I'm very bullish on LA. All right, so back to the idea of, these round names. One of the things that comes out of this is not just the valuations and how much money, but of course, how much are you selling? What percent of the business do founders sell in each one of these rounds? This is another place where the standard wisdom around venture is actually proven out by data. It's about 20% in your seed round, 20% in your Series A round, and then down the line for B, C, and D. And those really haven't changed much. 20% was what we saw in 2021 for a seed round. 20% was basically what we saw for 2021 in an A round as well. So that's a good place to benchmark. There are deals at 30, there are deals at 15, et cetera. This is a distribution, but as a median, 20% is probably where you want to be shooting for. That has a lot to do with the fund economics as well as what the founder wants, of course. But fund ownership targets, 20% is kind of comes out of a lot of that venture math. But of course, if you're a founder, you may not end up raising just seed to A to B. You might need to raise an A and then an A2 or an A plus, a bridge round, an extension of some kind. And those are expensive. So we see about, if you sell 20% of the business in the A round, you might sell another 9 to 10% in the bridge round. So bridges are unfortunately becoming more common, but are not something that founders should try to plan for. They can be very costly in terms of equity. And how much you sell of the business is not the only consideration during these deals. You'll also want to keep track of the terms at which these deals are transacting. So things like high liquidation preference, which we define as anything with a liquidation preference multiple over 1x. They're becoming more common. Good to see that that's not very common still in the early stage, but B or Series D rounds, there are higher liquidation preferences being requested by investors and being accepted by founders. So definitely worth investing in a good lawyer if you're going to be raising traditional venture dollars. And some good news. With all this fundraising downturn, it kind of impacted the number of acquired companies in 2023, but we've seen a good, strong bounce back in the number of startup acquisitions in 2024. I do expect that 2025 will be even better for startup acquisitions. Now, of course, the next question is, well, is anybody actually making any money out of these acquired startups, or are they mostly just acqui-hires or fire sales, things like that? My instinct is there is a lot of acqui-hires and fire sales going on, but we're starting to see more quality exits for companies that had raised significant capital as well. So hopefully we can do some reporting on this next year that kind of breaks out, what percentage of exits do founders actually make money on or make significant money on? That's a new analysis that I want to do next year for sure. If you were looking for one big story other than fundraising for venture over the last 2 years, I think it's this one, which is headcount growth at startups. So I'm going to flip to the next slide actually, because I think it tells an even better story. The black line in this chart is just the number of new employees hired at Carta startups every month. 70,000 new hires in January 2022, 27,000 new hires in January 2024, and there were many more companies on Carta in January 2024 at that point. So startups are being very selective about the people that they hire. And as you can see from that total departures line, which is the summed addition of the people who leave by choice in the green and the people who are laid off in the orange, you get that purple line, total departures. In many months over the last 2 years, it's been above new hires. So the startup industry as a sector has actually shrunk in many of those months. It's a major change from, tons of new people joining in all of the months of 2020, 2021, and 2022. That has an obvious impact at the individual headcount level of each of these companies. If you judge it just based on how many people worked at this startup on the day they raised the round. So in Series A, it used to be 20%, or excuse me, it used to be 20 full-time employees at a Series A company. And now it's more like 16 employees at a Series A company. And by the end of the year, it's probably going to be more like 13 employees. So smaller teams moving faster is definitely true across most of our data right now. As you might expect, of the hires that are actually getting hired, engineering is the number one function. I guess AI hasn't replaced all those engineers yet. Sales is the second, and then on down the list, marketing, ops, et cetera, et cetera. And all of this discussion of hiring and the changes in the labor dynamic within startups, this is the outcome of those changes. So this chart shows you the compensation for the average startup employee. About, a little bit of salary increase since November 2022. Not much, basically flat. That's the orange line. But the average equity package given to an employee at a startup is down 36% from November of 2022. That is a major shift. And that basically resolves down to supply and demand. If there are far fewer hires being made and a lot of quality candidates based on those layoffs available in the market, then startup employees have less leverage to negotiate great equity packages, and those equity packages have fallen. We think that equity is a lot easier to cut back on than salary. A lot of employees don't actually know what they should even ask for when it comes to equity. So it's unsurprising to see the equity part of this compensation being changed a lot more than the salary part.
Peter, before you move on, can I just ask a question actually about the previous slide? I just listened to the 20 VC podcast where Salesforce was mentioning that they would, for 2025, one of their goals is to actually not hire any more engineers and now start hiring more salespeople. So just want to know your thoughts about that. Does it actually change per round? And like who is getting hired and where as well?
This is one of the things that is most constant. It doesn't change per round. Engineering is always the most hired function, no matter if you're talking about seed stage or super late stage. Obviously, Salesforce has been public for a long, long time, so I don't have data on public companies. But engineering is always the number one hire. I'll cautiously disagree with Benioff there. I don't see engineering hiring going away. I would expect the impact of AI to start showing up in other functions well before it shows up in engineering. But I might be wrong about that.
Nice. And do you see a difference in the geolocations or where most hires happen for sales, like, or maybe even like with the sectors like fintech, for example? Yeah. Is it more like salespeople being hired versus engineers? Do you have any data around that?
So by sector, again, biotech is a little different. If you're hiring scientists, that's a we call that research function, and that only really shows up in a couple industries. But if you took this chart and just like filtered it to each individual sector, honestly, it looks pretty similar. Depending on gaming versus SaaS versus fintech, like they all want engineers. Location is really interesting. There's a sort of two stories happening at the same time. There are more startups that are experimenting with outshoring, so hiring whole teams of either engineers or customer success, et cetera, abroad. And then there are teams that are hiring only in like no remote at all in person. The all in person is actually oddly much more likely at the earliest stages. So companies that are less than 10 people tend to be more in person than companies that are not. But there's a lot of different methods. There's no like really one rhyme or reason to it. Companies are just trying to get the best talent and they're doing so in all sorts of different ways. And it kind of depends on what the founder believes as to the remote strategy and all that kind of stuff.
Nice. And that a follow-up question on what you just mentioned with remote workers hiring
Yeah.
outside of the US. How does that change in terms of equity and even, like pay salaries?
There are massive differences. So we actually have a full report on this. If you go to carta.com/data, that's where we keep all of our reports. It's called the State of Startup Compensation. So international employees are not paid the same salary as I think there was one point in the pandemic where there was this idea that eventually, all level 5 engineers across the world would get paid the same amount. That has not happened at all. The number one input to the salaries outside of the role itself is the location. So, and then equity packages are actually generally speaking even more different depending on location. So, startups are taking advantage of labor arbitrage across the world for sure. And even within the US, there's different pay packages for different places. Okay, when and where. Wrap up here, and then obviously we'll save a little time for questions as well. One question we get all the time is when are these deals being signed? And oddly, if you just look at the actual date of the signature of the term sheet, the month with the most signed term sheets is this month, December. However, that's a little bit odd because, of course, not a lot of rounds are started in December. The negotiations don't generally begin now. It means they were happening in October and November, and the deal just gets signed before the end of the year. And you can see that very clearly in the numbers in January and February, which are typically the slowest times for new venture deals because not a lot of deals got started during the holidays. So if you're a founder listening in here and you're thinking of, kicking off a fundraising round, I'd probably wait unless you have some really hot interest already. I'd probably wait until the start of 2025 because it's going to be more difficult to get a hold of investors over the holidays for sure. You can see some differentials again by month here on when deals are signed. Typically, a lot of deals are begun in January and then they end up signing in March and April. We already talked about this a little bit, but from our data, there is no such thing as the death of Silicon Valley. There is no next Silicon Valley. It's just Silicon Valley. The Bay is definitely the number one ecosystem for startups. Whatever erosion you saw in a little bit of that capital accumulation to Bay Area startups has been completely eclipsed by the boom in AI. So 35% of all capital for us for seed and Series A goes to Bay Area companies, but 45% of AI startup capital goes to the Bay Area. So if AI is the next big thing in startups, it's definitely living in the Bay Area more than other places. While I say that, there's also a wonderful array of great places to get started in a way that there really wasn't 10 years ago. So every one of these ecosystems, LA, Seattle, Austin, DC, Denver, Boulder, et cetera, they're all very developed venture ecosystems for seed and Series A companies. So you can get funded basically anywhere. When you look towards Series B and beyond, those later stage rounds tend to happen in the Bay and New York and other big ecosystems. Brian has a question here about or thought about Miami. Brian, you are anticipating this perfectly. What can we learn about Miami? So Miami is everyone's favorite punching bag on Twitter, mostly because Keith Raboy just won't let it go. And so I had to dig into the data and figure out what's going on. And I think it's actually really interesting. Miami is both a great and a not so great ecosystem. It is number 6 in the US if you just look at pre-priced rounds, rounds done before any priced funding on safes or notes. And it's number 8 at seed. So what does that tell us? It tells us that, as you would expect for a growing ecosystem, it is not competitive at the late stage, but it's actually doing quite well at the earliest stages. So both people, the people who love Miami and the people who hate Miami, they're both right. And this is, I think, useful when we talk about other ecosystems. You do not grow a venture ecosystem with late stage rounds to begin with. And late stage rounds, like the $100 million rounds that you read about in TechCrunch, those do not exist in small ecosystems because the companies are not big enough to take those in yet. Venture ecosystems have to start at the earlier end and then grow up into late stage rounds as companies that were born there get big enough. So I think actually Miami's doing quite well for how long it's been on the venture mind, which is only really for maybe 5 years. So I think this is pretty impressive from Miami overall. The other thing that I'll point out is that most venture ecosystems, they don't start at pre-seed, they actually start at seed. Most of the time we see venture ecosystems start at the seed round and then they grow into the A and then they kind of go back into angel and pre-seed as well. It's a weird dynamic. Not something that I expected, but that the data is actually very clear about that. Seed is the place where a lot of venture ecosystems get started. All right, questions. So, Carmen, you had a question on buyers for these startups. So, yeah, who purchases these companies? It's always the 3 big buckets, which are big tech, other startups, PE. Right now, PE is taking up the lion's share of those purchases, private equity. But who knows? Big tech might get back into the game in 2025, maybe a little bit more lenient regulatory environment. We shall see. Other questions?
I have a question about your post this morning on Twitter. Will down rounds fade in 2025?
The last 2 years for down rounds have been really rough. Almost 8% of early stage seed and A rounds, primary rounds are down rounds, 25% of bridge rounds there. So it's just a really tough environment for down rounds. I'm hopeful that next year we'll start seeing those percentages decline as all the wildness that happened in 21 is kind of works its way through the system. But I kind of thought that would happen this year, and I was wrong. So I don't know. It could just be another year of down rounds, which are really not fun for anybody. Stevie, you asked a question about people selling private company shares. So that's what we call secondaries. Secondaries are more active than they have been for a little while, but I think it's underrated the number of hoops you have to jump through. If you want to sell an individual share in a private company, you need a lot of permissions from your CFO, from your CEO, from everybody. So a lot of deals are out there to be done, but not a lot of deals are actually happening. I was actually looking at Luis's question earlier, which was around bridge rounds. How is it different from the next normal round? So it's actually quite different. One, it's typically for a lot less money. 2, it's in the same named series as the prior round. So you don't call it a Series A, you call it a Seed 2, Seed Preferred. And we can actually see that in the round docs because we have those documents. Third, it is almost always led by investors who are already on the cap table. So it doesn't include as many outside investors. I think it really is different, sadly, because when we look at the differences in the way that those companies actually function beyond that, it's quite different. I think bridge rounds are great for companies that can get them, but companies that take on a bridge round at the Series A or beyond are much less likely to make it to the next named round. That's true across our data and has been for many years. So bridges and extensions are just like a whole different set of worms than the standard up round that you might have. George, your question on preference for startups internally to remain lean. Yes, there's definitely, as we saw from the comp data, a preference many times for startups to stay smaller now in terms of headcount. Your point on vesting schedules, if there's one thing that if you're a founder that you should take away from this call is that every single person in your startup must have a vesting schedule. Must. It is an absolute requirement, and that applies to the founders as well. One of the ways that we see startups die is if a founder leaves and they take 30% of the business away from them after a year. It's very common, actually. So if you don't have vesting schedules on your equity yet, I'd highly encourage them. Anyways, that was a lot of talking. Hopefully that was useful.
That was incredible. Thank you so much, Peter. We are at time. Any last thoughts or last words that you would like to leave us all with?
I'll do a little bit of crystal ball gazing for next year. I think next year is going to be a better year for founders, a better year for investors, but it's not without pain. So as much as we'll see fundraising get better, I do think a lot of companies are going to shut down. And unfortunately, I think a lot of funds are going to start thinking about shutting down too. So it's never just pleasant out there in startup world. So respect to all the founders out there trying to make it happen.
Well, thank you very much, Peter. It's an honor to have you here with us. I think that was very valuable to all of us. So we're very grateful of you and your time. Thank you very much, everyone. Thank you for joining and participating. And Peter, Happy New Year, Happy Holidays, and everyone enjoy.
Cheers. Thanks so much for having me. Appreciate it, y'all.